Central bank physically supported higher gold stair steps are going to continue to be anchored during 2025 at ever higher levels into an absolute minimum of $3,000 to $3,500. And while we will continue to evidence some continued defensive Fed pushbacks, and we've seen a few, but they're getting bought pretty quickly. And we saw that after an $800 rally into the end of the year. No big surprises here. What it did was get rid of all the froth and enabled gold once again to start to clean out any of this froth to start. And then each time underpinning itself at a higher physical support stair step.
Central banks are expected to continue supporting higher gold prices in 2025. With a minimum target of $3,000 to $3,500. While the Federal Reserve may attempt to push back, the market quickly absorbs these moves. After an $800 rally at the end of the year, recent corrections have cleared excess speculation, allowing gold to establish progressively higher levels of physical support. The speaker, AndrewMaguire, a well-renowned analyst, explains that gold is on track to reach $3,000 sooner than expected, likely before the end of Q1 2025. Refiners are facing 8 to 12 weeks of delays due to a massive supply shortage, forcing the Bank of England to lease gold to stabilize the market. However, lease costs have surged over 10%, adding strain to central banks. While the BIS and most central banks remain long on gold, a significant imbalance persists between the COMEX and physical markets. Despite LBMA vaults reporting 8,710 tons of gold, strong Eastern demand and expectations of higher prices are limiting supply. The ongoing physical shortage signals that gold remains significantly underpriced, driving refiners and wholesalers to secure NSFR-compliant gold to fulfill orders. AndrewMaguire highlights that the surge in demand from the Shanghai Futures Exchange has once again exposed weaknesses in the EFP system and tariff-related risks. Despite aggressive efforts to suppress gold prices in late 2024, including heavy selling, gold still ended the year with a $600+ gain as the Fed squared its BIS borrowed positions. The April 2024 launch of the Shanghai Futures Exchange revealed the LBMA CME paper gold manipulation, while tariffs further highlighted the lack of physical gold liquidity. The traditional banking cartel no longer controls Western gold, and any paper-driven price dips in 2025 will be short-lived, primarily shaking out a dwindling number of speculators. Many former COMEX players who once held up to 75% of unbacked open interest have shifted their focus to Bitcoin. As you watch the video clips, please take a moment to like, subscribe, and hit the notification bell to stay updated with our latest uploads.
On the 19th of January, and most importantly, as you say, what to expect as we head into what looks like $3,000 gold, likely to be achieved well ahead of the end of the first quarter estimate. Now, with refiners reporting between 8 to 10 week delays and actually as long as 12 weeks to obtain any size of refined gold bullion, the Bank of England is having to step in to lease gold to try and flywheel the massive supply deficit. However, these lease costs have risen by another 8% above where we were just 2 weeks ago. They're in excess of 10%. And while these Bank of England leases are 100% hedged with risk exposure of further higher lease costs, these are laying on the books of the central banks of basically the US and the UK central banks. The BIS is long gold, and every other central bank is long gold. The only problem lays with the imbalance between the COMEX and the physical markets. Ultimately, the COMEX, as we said last time, has to become compliant at some point. So, yes, the LBMA vault statistics evidences there's 8,710 tons of gold, supposedly, available immediately, with about half owned by central banks. But the reason we're not evidencing much outflows from the LBMA of the non-owned central bank gold is because Eastern demand is so strong and the higher prices are being anticipated, which means very little of this gold is put on offer because they're expecting higher prices. At current prices, that is. There will always be plenty of gold and silver on the market at a fair price. It's not a fair price. The unprecedented physical shortages are actually telegraphing the physical supply-demand equilibrium gold price is significantly underpriced. And this is serving to drive more refiners, wholesalers to lock in NSFR-compliant FX gold to meet backing up orders at current prices.
And that's pretty much what we saw. The Shanghai Futures Exchange sudden demand, what it did is expose the EFP scam. And tariff tail risks have once again exposed it one more time. And as we evidenced into the $800 rise into October 2024, and despite throwing the absolute kitchen sink at gold into the end of 2024, we still evidenced a final close at the end of the year where the BIS squared its last positions. Where the Fed squared its BIS borrowed positions at the end of December. And we still saw an over $600 final settlement into the 2024 close.
So while it took the Shanghai Futures Exchange launch to expose the massive LBMA CME paper gold fraud in April 2024, tariffs have simply exposed the fact that there is not enough physical gold liquidity to paper over the fact that Western gold is no longer in the hands of the cartel, and the scope of any such paper-driven counterintuitive dips throughout 2025 will once again, as we saw in 2024, be limited to rinsing out an ever-dwindling group of speculators willing to risk betting for or against gold for that matter. And many of the momentums who have historically controlled up to 75% of all the unbacked cash-settled COMEX open interest, they left, anchoring their boat to Bitcoin.
Andrew exposes that the Federal Reserve remains the only central bank actively attempting to cap gold prices in dollars by borrowing physical gold from the Bank for International Settlements, BIS, as it lacks sufficient reserves. However, this strategy has backfired, with the Fed consistently borrowing gold at lower prices and repaying at higher levels. A recent attempt to suppress gold's New Year surge appears to have been thwarted by rising lease rates, while the delayed BIS swaps report raised further suspicions. Andrew discusses that the Bank of England and CME are reportedly coordinating efforts to manage the situation. Still, growing global awareness, especially among BRICS central banks, suggests confidence in Western price suppression mechanisms is eroding. With EFP spreads indicating the COMEX must either comply with Basel III or face failure, the U.S. Treasury may be forced to revalue its gold reserves, potentially triggering an overdue audit that could expose the extent of gold rehypothecation. Moreover, AndrewMaguire explains that the market is beginning to recognize the massive gap between physical gold's actual value and the paper-diluted prices driven by leveraged trading. Until Basel III compliance took effect in January 2023, spot gold, like silver today, was primarily traded on an unallocated and cash-settled basis, with only a fraction of daily transactions resulting in physical delivery. This miscalculation by Western institutions has allowed BRICS central banks, particularly China's PBOC, to exploit the situation by locking in physical gold purchases, further driving up prices. As confidence shifts and physical gold liquidity tightens, gold's accurate market equilibrium price is expected to rise significantly, exposing the fragility of paper-based gold markets. Now, let's dive into the interview.
The Bank of International Settlements' own data, and 100% certain the Fed is the only central bank that has actually been seeking to cap gold priced in dollars from rising by borrowing physical from the Bank of International Settlements because they don't have it. So here are the points we drew attention to when the BIS swaps leases were added to or cut. And so now our feet, and we see it here, 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 here. Note that they are closing, they're borrowing gold at lower levels and then having to pay it back at higher levels and then reducing their exposure at higher and higher levels. Now, yes, we saw a little bit of a pullback into the end of December, but actually we think something here was fudged. And our feedback suggests the Fed tried to double down to borrow more physical gold from the Bank of International Settlements to try and cap the rising New Year gold price but got caught out by the spike higher in lease rates. Now, looking at the larger picture, it was no coincidence the BIS swaps report was delayed. Even by a day, this has never happened before. And by their own admission, the Bank of England and the CME are working together to manage the situation. And this failure to deliver that report on time suggested that the minuscule 3-ton reduction from 81 tons to 78 tons was actually fudged and had not gone unnoticed by foreign central banks, sovereigns, and global-facing institutions, underscoring our liquidity provider assertions that the joint US and UK LBMA COMEX enabled price suppression policies are folding.
The EFP spreads telegraph the COMEX has to become Basel III compliant, or it's going to have to fold. There's too much to lose to fold. It's not going to happen. Raising margins to meet compliance will have to follow the US Treasury at least partly or ahead of the US Treasury at least partly revaluing US gold reserves. Doing so will likely force an unwanted Treasury audit, because after all, if you're going to revalue gold, when was the last audit? In the 50s? I mean, it's ludicrous. Of course, no, it would have to be audited, but that would likely be dragged out long enough to buy time to go to market to buy back rehypothecated US Treasury gold. Now, revealing this vulnerability into BRICS central banks in particular, the PBOC, from locking in spot gold to exploit the buyback of these swaps is driving the price higher. They know what's going on. Of course they know. And no one really knows the degree of rehypothecation relating to this 8,000 odd tons of US gold. Of course not, because no one's audited it. Therefore, it's not possible to estimate how much gold has to be bought back at market to repay these double ownership positions. But one way or the other, EFPs have exposed the paper to gold abyss, and the offer price to sell real physical gold will rise to an equilibrium level significantly higher than current paper prices, paper diluted prices. There's a massive gap to fill here. And up until the 1st of January 2023, Basel III compliance, spot gold, FX gold, had traded on an unallocated basis, like silver at the moment, and it was being largely cash settled. And as with every other foreign exchange cross, long or short positions could be cash settled amongst the LBMA market-making bullion banks, with only a tiny percentage of the hundreds of tons of FX gold traded every day being ever physically delivered. And that's the mistake that they seem to think.
The ongoing strain in physical gold markets, rising central bank demand, and tightening supply are setting the stage for significantly higher gold prices in 2025. With the Federal Reserve struggling to contain price movements and BRICS nations capitalizing on the market's imbalances, the shift toward a more transparent and physically backed gold pricing system appears inevitable. As Western paper gold mechanisms face increasing scrutiny, the actual value of gold is likely to emerge, further driving up prices. How might a U.S. Treasury gold revaluation impact global gold markets and central bank reserves? What are the potential consequences if COMEX fails to meet Basel III compliance requirements? Let us know in the comments below. For more content like this, don't forget to subscribe to our channel, hit the notification bell, and explore our other videos. Thanks for tuning in.